My name is Robert Mulroney, and I'm a co-founder of Mindset Wealth, senior investment advisor with IA Private Wealth. Unfortunately, Russ Waggle, one of my partners, had a minor family emergency, so can't make it. But we will continue on. This is our 17th annual Look Ahead conference. James, I think, has been here for, we're trying to think about it, 5 or 6 of them. Is that about right, James?
Yep.
Yeah. So last time was January of 2020, and we'll talk about that. So looking forward to it. Want to introduce the team, Mindset Wealth. In the next slide, so there's myself, Robert Mulroney, Russ Waggle. It's a tall guy in that picture. We have Rudy Chung in Vancouver. We just did a podcast, Rudy and I, and it just dropped. That's what they say. They dropped it today, which is nice. That was on the First Home Savings Account. So if you get a chance, share that with someone that is buying a house in the next 5 years or 10 years or 15 years. And Laura Nickel. And Laura just last year has become an associate investment advisor. Okay. And then there's Jessica. And Jessica is, so there's these designations. Jessica is licensed assistant. Thank you very much. And the newest member of our team is Vash. Where is she? In the back there. She's not in the pictures. She joined us in November. And Vash is from Mumbai, India. So welcome. That is our team. And so tonight we're going to, obviously James is going to be the main speaker. But Bill Parkinson and I got together in the fall. And Bill is an instructor up at North Island College, teaching management courses at School of Business in North Island College. And Bill recently has completed his retirement coaching designation. So we got talking about how retirement is for folks. And I've been in the business now, it's 29 years, so I've seen all different types of retirement. There's certainly, we all know the Tom Brady's of the world that retire and then come back, and then the wife says, see you later. There's that retirement, and then there's people that retire and they're just happy. They say, I wish I would have done this 5 years ago. So it's the mindset of retirement. And we have a presentation planned for May 9th, where it's going to be Bill, and we're thinking maybe a panel of clients and maybe 3 or 4 retirees just to discuss the whole mindset about it. And without me going on about it, let's talk to the expert. Let's call Bill up to just give us a teaser on May 9th.
Thank you. Pleasure to be here. As I look out, I'm wondering how many of you are already retired? And I was talking to a couple educators. They're just on the path to doing that. I understand the feeling. So it's a pleasure to be here to talk a little bit about aspects of retirement that often go neglected. So when we think about traditional retirement, we think about it from a financial perspective, which is important. And when you plan financially, it's important to have people that you trust and that have integrity and that you can go to see and get straight answers. So Robert and Russ and the gang at Mindset Wealth have you set on the financial angle. But there is more to retirement than money. And as many of you have already experienced in your retirement. So there's 4 areas I want to bring to light that are worth some consideration as we think about transitioning into retirement. So I'll just identify them, and then we can just spend a few minutes unpacking this before James takes the stage. So spiritual, mental, physical, and social connections and relationships are all important considerations as we think about leaving the workforce and transitioning into retirement. So as we look at number 1, spirituality, thank you, Laura. This is a very individual and personal aspect of retirement. For some people, spirituality means affiliation with religion or a relationship with God. For some people, it doesn't mean that at all. The important thing to consider here is that regardless of what category you're in, you want to be really clear what your values are. And working with people on values has been a very interesting experience for me. People are usually very good with the top one or two, and the usual suspects are family is my top value, or health, maybe my relationship with church. But other than that, when you start digging down, people need a little bit more introspection on what those values really are. But if you can live your life in alignment with the things that mean the most to you, you are going a long way to ensure that you are enhancing your purpose and meaning in life. So spirituality is a sphere that is worth considering. Next one, thank you. When it comes to mental health and emotional well-being, I think intrinsically we all know that if you're well mentally and you're stable emotionally, you're probably going to enjoy your retirement a lot more. But that can be challenging when you're taken outside of the structure that you've been embedded in for 20, 30, 40 years. So it can feel like maybe you're a little off kilter, or the ground is shifting a little bit. And speaking to some people in my work who have recently retired, that is a feeling that seems to be quite common for some of them. And all the extra freedom that we think about when we plan ahead for retirement sometimes is more challenging than we think it might be. If you've been working for 40, 50 hours a week and all of a sudden you're taken outside of the fabric of that structure, it can be challenging to know what to do with all that extra time. So how will you replace your work identity? Core to this is, what do you really want to experience in retirement? How do you want to grow? How do you want to contribute? So the need for lifelong learning is not something that stops on the day that we stop working. People have a desire to continue to learn, to grow, to evolve. So what will you learn about? Have you thought about it? Do you have a plan for that? That's an important consideration. And in terms of the last bulleted point, just a brief word on grief. Grief is a normal human response to loss. But it doesn't have to be only death related. It can be loss of identity because you're leaving a career. It could be kids leaving the house and you're empty nesters. It could be loss of hearing. It could be a lot of things that we need to mentally prepare ourselves for in terms of transitioning into retirement. So what is your plan for that? Excellent. When it comes to physicality and physical health, the key term I want to float by you tonight is functional fitness. It's not about running a marathon, although if you want to, go for it. But it's all about having the physical capability to be able to partake in those activities that give you meaning and that you enjoy. So if you love to garden, but you have arthritis in your hands that's getting worse, how are you managing that so that you can continue to enjoy that experience? If you love walking and you want to go on a walking tour in Europe, but you have chronic knee issues, how are you managing that so that you can still partake? And of course, when we do activity, it helps us to do activities that we really enjoy. If you hate the gym, don't go. Find something else that floats your boat, right? This lovely couple loves ballroom dancing. Great for the brain, great for the body, great socially. Find something that you enjoy. Have you thought about that? Do you have a plan for that? That's a worthy consideration as well. So what are your preferences? And lastly, social. We are wired to be social beings. We are wired for connection. We need each other. When we have rich personal relationships, we can add layers to our life that we can't have when we're by ourselves and we're isolated. Okay? And the other thing that we know is that the quality of our relationships trumps the quantity. You can have 10,000 Facebook friends and be the loneliest person in the room. But if you've got just a couple really good friends that you can count on no matter what, that can do wonders for your overall wellness. So some things to consider here. We have an epidemic of loneliness and isolation in our society. We're not as much of a community as we were 100, 150 years ago out in the farmlands. We've become more isolated from each other. A lonely brain is not a happy brain. Okay? There are significant risks of all kinds of mental and physical issues when you have chronic loneliness creep into your life. Being socially connected boosts your immune system and reduces your chances of chronic disease. On average, when we work, we have 22 high-quality contacts a day. The day we retire, that number is cut in half, and often of lesser quality. What is your plan for staying connected? What is your plan for staying embedded in the community and having deep and rich personal relationships? So, the reality is that retirement planning does not need to be overwhelming or onerous. In fact, it can be a lot of fun and it can be educational. Taking the time, the hours to spend just on yourself can be very rewarding. And why wouldn't you plan for a stage of life that could last for 30 years or more? It's interesting, you watch people plan for hours and hours and hours for a 2-week summer vacation, and they don't spend any time at all planning for a phase of life that could last for 30 years. Plan for the vacation, do that. Plan for retirement as well. So, as we bring it all together, you'll see that there are 5 major elements that allow us to create a comprehensive retirement plan. Robert and the gang at Mindset Wealth have you squared away on the financial aspect, which is incredibly important. Nobody wants to run out of money. Nobody wants to start retirement without enough money. But there are other non-financial factors that can greatly enhance the enjoyment that we have in retirement. And so what is required is conversations, assessments, more conversations and listening to help identify areas where you're strong, where there might be areas where you have gaps that need closing so that you can make the transition into retirement as smooth as possible. So, my name is Bill Parkinson. I am a retirement coach. Thank you to Robert, Russ, the group at Mindset Wealth for inviting me tonight. I've enjoyed the conversations. When you can take the financial aspect of retirement and you can combine it with the non-financial, you have a full retirement picture. Thank you.
All right. James Gauthier. So James is VP of Investment Products and Platform. I've known James for a long time, back since 2005, 6 anyways. Yeah, something like that. Last time James was here. So James is the advisor to the advisors, okay? And dealing with advisors is pretty difficult because everybody's is going 100 miles an hour in 100 different directions. So James corrals it all, puts on a fantastic look-ahead conference every year for all the advisors in Canada. There's IA Private Wealth, IA Financial manages 200 billion in Canada with 4 million clients. So yeah, James has got a lot of responsibility on him. So last time James was here was January of 2020, and my son, who's not here today, I looked at his notes. He took 2 pages of notes, and Kevin would have been 18 at the time. And one of the highlights was SARS-like flu, watching. And I said, and we know that, yeah, it was a little bit more than that. So, but yeah, so very much value James' advice and thank him so much for coming in. So please welcome from Toronto, skiing tomorrow with us, James Gauthier.
Thank you, my friend. I always love coming to the island because where else can you surf, ski, golf, fish on the same day in February? I think in Ontario you can do one of those at a time on any given day, so it's a lucky place for you guys to be. I usually like to move around a bit, so it's going to be a little bit uncomfortable for me not wanting to jump out behind this, but I know you guys are recording it. And you can all hear me okay, I'm assuming? So I guess as Robert mentioned, I was here virtually a month before the world shut down. And if I were to tell you that between February 17th and March 20th, that the stock market would be down 35%, would you have guessed that? Probably not. If I had told you that by September 1st, 100% of that would have been recovered, while everybody's thinking the world is coming to an end, you probably would have said I wouldn't have guessed that either. So what I'm trying to demonstrate is that I'm not here to forecast, because I think forecasting really is folly. Nobody can do it with any sort of accuracy, just given how dynamic the world is. There's so much going on. What we can do is sort of give you a lens into what's happening as far as the economy is concerned, as far as financial markets are concerned. So Robert Mulrooney, Rob, and Russ are financial advisors. And from my perspective, the work that they do with all of you and the rest of the clients of Mindset, certainly the most important part of that is the financial planning that is tailored specifically to your needs. So what we're going to be doing is talking about the landscape and stuff that's important, and keeping your eyes on the road, especially for someone like Rob and Russ, in terms of what they do on a day-to-day basis, is really important. But anything I say today, anything I say a year from now, 2 years from now, hopefully that is not going to cause your financial plan overall to deviate all that much, because your financial plan is unique to you, whether it's 5, 10, 15, 20 years out, could be longer if you've got a legacy that you're looking after. So what I'm going to go through here really is just sort of a lay of the land, kind of a perspective, the house view of what we're seeing at IA Financial Group. But really, the man you want to listen to is right up front here. So I'm here to just add a little bit of context around that. I come from Toronto, I come from head office, so I come bearing a lot of charts. What I'm going to be doing is probably just trying to speak to those charts without getting too much into the weeds, just to kind of give you the high level. I'm hoping to wrap it up in 20 minutes or so, and do some Q&A if you have some questions, or if anyone in the audience has questions. This is casual. We're in Vancouver Island. Feel free to just throw up your hand if you have questions along the way, and I'll try to get to them as I can. But as Robert noted, I'm with IA Private Wealth, head office, parent company is IA Financial Group. And just in terms of the relationship that we have with Mindset and Robert is not an employee of IA Financial Group or IA Private Wealth. He's an independent agent, an independent business owner. He's free to do what he wants within the bounds of the regulations in order to make sure that you succeed in what you want to do in life. So he can put together whatever portfolio he wants, using whatever products he wants based on your unique needs. So we are partners with Robert and with Russ. So we provide sort of the back office and administration and this sort of thing. But as you noted, Rob, the parent company, IA Financial Group, has total assets of about $200 billion. Within the overall wealth business that Robert is a part of, that's $100 billion. So this is a very sizable organization. IA Financial Group isn't that well known outside of Quebec, but in Quebec, it's extremely well known, and I think the familiarity of the organization is growing across Canada. 4 million clients, as Robert mentioned, 10,000 employees. So the point in saying all of this is that you are backed by a very, very large and strong financial institution that has its tentacles into all sorts of various business lines within Canada and the US. So again, we're partners with Rob, we're partners with Mindset, and we're here to support his business and to help all of you succeed along the way as well. So I'm going to start talking about just the economy, talk about financial markets. We're going to keep it light, we're going to keep it casual, but there are a few things I want to touch upon. Now, if I was here a year ago talking to you about the forecast of IA Financial Group, I think if any economist was up here talking about their forecast for 2023, what they would be telling you is not if we're going to go into a recession, but when that recession would be, okay? A year ago at this time, everybody was pretty negative, okay? Inflation was still rampant, interest rates were rocketing, the stock market was teetering, but guess what? We didn't see a recession at all, okay? There wasn't a recession. It was the worst call I've ever seen in terms of economists, and economists, it's more art than science, but in this case, everybody got it wrong, which brings us to today. We're in an environment where interest rates have basically gone from 0% to 5%, but at the same time, inflation's gone from 9% to 3.5%. So the point of this rate increase regime really is to battle, or was to battle, that inflation bug. And inflation is really the primary poison, the most toxic thing for an economy. which is why policymakers, the central banks, the Bank of Canada, do what they need to do to ensure that inflation is reduced, because inflation truly is insidious. We're almost where we need to be, but we're not quite there. And that's potentially a major headwind for 2024 is what are central bank policymakers going to do to get inflation to that 2% target? Again, right now we're 3.5%. So it's a little bit nagging. We're much of the way there, but a lot of that final mile could actually be the hard work that will be required to do. So what we're hoping we're going to see this year is what's referred to as a soft landing. So if you read the financial press and even the mainstream press, there's often talk of a soft landing. So what is a soft landing? A soft landing is when central banks put pressure on interest rates in an effort to reduce inflation, but they do so in a way that doesn't crack the economy. Because sometimes when you raise interest rates too rapidly and keep them high for too long, that's what puts the economy into a recession. So it's sort of a tricky balancing act. And really that is the goal of policymakers here. And we'll see what happens. But I think at this point, the consensus is that's what's going to happen. And certainly if you look at what's happening with the stock market, where we're at record highs right now, the stock market is telling you that, yeah, that's going to happen. So if it doesn't happen, it's probably going to be a fairly negative thing for the stock market, probably a rather positive thing for the bond market, which tends to go inverse to the stock market. So that's what everybody is paying very, very close attention to, who follows the economy, who follows what's happening within financial markets. Now, as far as inflation is concerned, again, I mentioned 9% or thereabouts was the peak in July of 2022. Okay. Since then, we've seen interest rates go up by 5% in Canada, 5.5% in the US. And the reason that central banks raise rates is because that puts pressure on, if your mortgage rate goes from 0 to 5%, you've got less money to spend on stuff, which is going to reduce demand, which hopefully will help cool that inflation bug. And that's really the purpose of it. Now, the issue with this most recent bout of inflation was that a lot of it was driven by factors that were not necessarily based on demand, they were based on supply. So, you've probably heard, I think one of the most well-known anecdotes was what happened with the new and used car market, right? So new cars are heavily reliant on computer chips and technology, and because of shipping challenges during COVID, a lot of these chips come out of Taiwan. There was all sorts of shortages, and shipping lines were impacted. As a result, production of vehicles sort of plummeted. It was hard to find a new car. I can remember just driving by the auto mall in Toronto, where you've got 4 or 5 different dealers kind of lined up. There were no cars, new or used, in the lots. And as a result, you saw used car prices spike by 20, 30, 40% year over year. Okay, so that was not something that was driven by really demand. That was driven by a lack of supply. So we've sort of moved beyond that phase. Whether it's used car prices, whether it's energy, this has come down. So we've gone from sort of 9% back to 3.5%, but it is kind of sticky. So we need to see what's going to happen with that. And until we can get back down to that 2% level for inflation, the potential for rates to stay higher for longer is going to continue to exist. Now, fiscal policy is basically government spending or government taxation. All right. So what do we have in the U.S.? Well, it's an election year. And even though the U.S. is running, spending money like crazy, that's all we're hearing about is the budget deficits. I can guarantee you that the White House is going to do anything it can to ensure that spending continues, because the last thing you want to do is pull things back and upset your voter base in an election year. Now, what happens after that is anybody's guess, but I think the bias is that moving forward, you're going to continue to see the pressure on fiscal spending, and fiscal spending in the long term potentially is inflationary as well, and also could impact interest rates moving forward. Canada, sort of a similar situation. The next expected election is October of 2025. What happens between now and then, just given the way our system works, is we could have a non-confidence vote at any given time. If it comes to that, we'll see. I guess it's a function of really what the NDP wants to do. But the question is, we're carrying pretty substantial budget deficits in Canada. And our friend Pierre, on the conservative side, is really pestering and pressuring the liberals to tone things down. So the question is, do they take their medicine in advance of the election? We're still talking about 18, 20 months from now. Or do they just try to ride it out and say, we're not going to listen to that. We're just going to spend rampantly and see where that takes us. It could go either way. We'll see. But fiscal spending, again, tends to be a more inflationary thing, and that's going to impact what the Bank of Canada is going to do. And then finally, monetary policy. So monetary policy is the interest rate regime of the central bank. So right now, markets are pricing in, I've got 4 to 6 rate cuts there. It's actually now 3 to 5. This past Tuesday, there was a much higher than expected inflation number out of the US, which sort of spooked markets. But the bottom line is that the expectation is that rate hiking is over. Rates are going to go down. Whether it's 2, 3, 4, 5, 6, it's sort of anybody's guess. But I think what matters most is, why are those cuts happening? Are they going to be happening because the economy is starting to crack and the government and the central bank wants to support things? Or are they going to come down because naturally, the economy is working its way through the inflationary problem? Inflation is consistently low. They can afford to reduce to lower those rates. That's what everybody's hoping for. That's that soft landing scenario that I mentioned. So, these are the sorts of things like COVID, like the global pandemic. You can't predict them in advance with any sort of accuracy. But what you can do is sort of do your best to kind of game the odds and position portfolios accordingly. Okay, so, and then finally, what I should mention is the labor market. So everybody likes to get paid more, right? The problem is, when wage increases are running at a high rate, that's something that goes into that inflation number, right? So 3.5% inflation, much of that stickiness is coming as a result of the fact that wage inflation is high. So it's a little bit of a double-edged sword, right? People want to get paid more, but at the same time, those higher wages are leading to higher inflation. And when that happens, central banks might leave interest rates higher. Okay, so you can't get your cake and eat it too. So we're going to see how that all plays out. And it's possible that wage inflation could stay sticky, and we could see a reduction down to that 2% level, and central banks will be happy. But this is really one of the key things that the Bank of Canada and the U.S. Federal Reserve are watching at this point. Next slide. Okay, so I'm not even going to tell you what's on this slide, but basically what we're looking at here are forecasts of economic growth for various economies. Top line and comparing 24 to 25, okay? So what I want to demonstrate here is that the top line is China. China is still growing very rapidly, growing faster than the rest of the world. However, China's growth, you go back 10, 20 years, you see it growing at 9, 12% annually. Right now, Chinese growth is in the 4.5% range. So the economy has gotten to be so huge that sort of the law of large numbers is kicking in, and as a result, that number is lower. China at this point is, and I've got another slide on China, which is kind of neat. But China at this point is the second largest economy in the world. Okay, the U.S. being number 1, China number 2. Total GDP of the U.S. is around $25 trillion U.S. China is about 17 trillion U.S. Very different population basis, so per capita, it's a very different story. But China's gotten to be so big that its growth is slowing down just inherently because it's tougher to grow when you become so big. Now, the reduction in Chinese economic growth over the years has really pressured global growth because it was such a significant driver of that growth. So what we're looking in the middle, here in the middle, is sort of global GDP, or GDP being overall economic growth of the world. And the bottom part here, don't worry about trying to distinguish them. I can barely read it because I'm standing up here. But what we're looking at is growth of developed economies. And what we see is Europe, Canada, pretty anemic in 2024. The US a little bit better. And in 2025, the expectation is that things are going to be much rosier. But the bottom line is that it is pretty low. You're talking about 1.5%, 2%, which is a pretty low level of growth compared to where things have been historically. Now that's good because the central banks also don't want economies to be overheating. So certainly in terms of the growth element, things aren't overheating. But when you have an economy that is not growing, but there's inflation, that's a phenomenon which is known as stagflation. That's something we saw in the 1970s. highly, highly undesirable. I don't think we're in a situation where that's something that is going to come to fruition in any meaningful way. But the bottom line here is that growth is going to be pretty low, probably for at least the near or medium term. So the next slide. So China. China, which I believe was just recently overtaken by India in terms of India now being the most populous country on Earth. China had that crown for a number of years. But did you know that the population of China is now decreasing? Okay, so you're probably all familiar with the one-child policy, which was instituted decades ago, which is no longer in place. So the reduction in population is a function of that. But the birth rate of China is actually also not enough to sustain population growth, even though the one-child policy no longer exists. So, forecasters are predicting that by 2080 or the year 2100, the population of China will be closer to 700 or 800 million. Right now it's 1.4 billion. So that's a pretty incredible reduction in the population. Now, that being said, we are seeing something similar in Japan right now. Just Google Japan population 2010 and the numbers will shock you. Or 2100, or 2100, I should say. Europe, similar situation. North America, because of our immigration policies, a very different phenomenon. But, this is one of the reasons that, you talk about China and its economic miracle. Given that its population is now declining, the likelihood that it will ever overtake the US as being the largest economy on Earth, I think that window's closed. What we're looking at with this dark blue line here, this is what's known as the dependency ratio. So this is the number of people who are retired, 65 and over, divided by the working population. And what you can see is that by 2050, 2060, that number is getting to 50, 60%. So there will be more people who are retired than there are people working. And that's a problem, right? Especially when you're talking about who's going to support the pensions, who's going to support the other benefits. Now, the Chinese economy, Chinese society, they don't have all of the social safety nets like we have. There's no equivalent of CPP or OAS over in China. I believe they do have some sort of transfer of wealth to the elderly, but that's not a very positive situation for China. Very interesting phenomenon that I thought I'd mention because you hear very often about Chinese growth, and it certainly will continue to grow, but its impact on the world in the decades to come is only going to be on the decline. So next slide, please. Okay, let's talk about Canada here. So the definition of a recession from a technical standpoint only is 2 quarters in a row of negative GDP or negative economic growth, okay? So what we saw out of Q3 in Canada, third quarter, negative economic growth, which means if Q4 growth was negative, and we don't have all the data yet, but if Q4 growth was negative, then technically speaking, Canada was in a recession. Now, just looking at the numbers that came in for December, it's probably likely that we're going to avert a recession. Who cares if it's a technical recession? What matters more is how do you feel? But if you look at things on a per capita basis, so not just overall, but based on economic growth divided by the number of people in the country, things have been pretty bad. That's over here. For 4 or 5 of the last 5 or 6 quarters. And why is that? Frankly, a lot of it is because of the nature of the immigration that we're seeing in this country. I'm not making a political statement at all here, okay? So historically speaking, the sorts of immigrants who have come to Canada have been highly productive from an economic standpoint, highly educated, okay? What we're seeing now, and you're probably reading about the international students who have been flooding Canadian educational institutions. Now, when you're a student, at least I know when I was a student, I was broke as broke can be, okay? So when you're letting in a bunch of students who are not necessarily contributing to the economy, perhaps they will down the road, what that does is adds to the population base, and when that is the denominator, with the numerator being overall GDP, that's what results in that number being so negative, okay? So This is something that I'm reading a lot about in the Globe and Mail, which is not exactly a right-leaning newspaper, but the Globe and Mail talking about how these international students, a lot of the international workers are actually making Canada poorer in many ways. And I think you can make at least a valid argument when you compare that to the nature of the sorts of immigration that we've seen historically. And I know I've used an immigration chart at this presentation before, which showed that the average sort of income and average education level for a Canadian immigrant, going back 5 years ago relative to the rest of the world, we were at the top, right? So immigration was a major net contributor to economic growth and economic development. Again, these international students, maybe down the road at one point they will be, but there's a strong possibility that they will never come back to Canada. Anyway, the point of this is to demonstrate that Canada is, on a per capita basis, in a recession today. Next slide, please. All right, I'm going to totally disregard what's on the chart there. But what this is doing is demonstrating that the market is calling for 3 to 5 rate cuts this year. I sort of nicked this presentation from our senior economist and strategist, Sebastian McMahon. He believes that may be a little bit excessive. My view is I don't know if it matters that much. If it's 2, if it's 4, that's a move in the right direction. What matters more is why is the rate cut happening? Okay. If we get 6, if we get more than 6, that's probably a sign that we're in recession. That's not what we want. If it's 2, maybe it means the economy is doing better than expected. Maybe that means the stock market goes down a little bit. But generally speaking, the stock market is not the economy. The economy is not the stock market. Sometimes you got to take the good with the bad. We'll see where things go. Again, I can't predict where things are going to go. But at this point in time, you can see what the market is pricing in, just looking at what's happening in the futures markets. And right now it's 3 to 5. Okay. Now, if you have a variable rate mortgage, that's probably a really good thing for you. If you've got a fixed rate mortgage, maybe it doesn't matter. If you've got short-term GICs in your portfolio or like a high interest savings account, well, that rate's probably going to be coming down. So I'll leave it to Rob to talk about how you should be planning for that, but this is what the market is pricing in. Okay, speaking of markets. No, this is okay, so 2023, pretty good year. This year, so far, pretty phenomenal. I think if you look at the return of the market from, let's say, early November to today, another record high today, and compared to similar periods over time, I think we're in something like the 95th or 98th percentile. Markets are not supposed to go up by this much in 4 months. That's not to say they're bound to go down, but I wouldn't be surprised if at this point we get a little bit of a consolidation because things have sort of been rocket ship straight up. It's been crazy. And a lot of that was based on the function that, or based on the idea that the market came to terms with the idea that central banks would start cutting rates. So markets like it when rates go lower, assuming that it doesn't lead us into a recession. So it's sort of that balancing act. It's like a Goldilocks scenario. You want rates to go down, but rates to go down only because the central bank can afford to reduce them because they don't need to apply the pressure anymore, right? If things crack, things go into a recession, well, that's not good for the economy. That's not good for the job market. That's also not good for the stock market. It is good for the bond market, however, which is why it's important. Again, this is Rob's territory, but this is why you want to have that portfolio that's diversified and balanced, because oftentimes there are situations where something happens economically, it really hurts the stock market. What happens to the bond market? It's going to go up, right? Because the bond market is generally viewed as being a place where you want to be to find safety. That's the place you want to go when things get a little bit tricky. So if things get a little tricky in the economy and the stock market, people are going to go to bonds, and that's sort of the ballast in the portfolio. So this year, what are we saying? Well, we're at a record high. The valuations are high. Stocks are not cheap. That doesn't mean they can't get more expensive. But I guess the point is right now probably doesn't look like the best time in history to buy stocks. That's what I'm saying. Credit. Credit is basically non-government bonds, okay? So bonds from BCE or really any company that is investment grade. we've seen prices of those things get stronger. We've seen their spread, it's called, which is basically the premium in the yield that you earn to own a high yield bond or an investment grade bond, shrink. So you're getting paid less for that risk. Okay, the least. You may have whatever view on the Canadian government, the U.S. government, but generally Canadian and U.S. government bonds are viewed as being amongst the safest investments out there, like money good, right? And what we're talking about from a government bond standpoint is because interest rates have gone up so much, getting to that point was really tricky and really ugly. And if you were in bonds at 0 and they went to 5, you would have lost money. That's just a mathematical fact. Right now, though, we think yields are pretty attractive. So, you're getting a 10-year government of Canada bond is 3.5%, 3.7%. I didn't check today. A U.S. 10-year government bond, 4.2, something like that. So that's not bad for basically a zero risk investment over 10 years. And then finally, currencies and commodities. Our senior economist believes the U.S. dollar has peaked. And if you believe interest rates are going to go aggressively lower, that's probably the right call. As a result, we also believe gold probably will have a tailwind behind it. Because generally speaking, there's an inverse relationship between the US dollar and the price of gold. That's generally because the US dollar is gold generally is priced in US dollar terms. So that's how that inverse relationship typically works. That may matter to you if you're here, you're not a snowbird, I'm assuming, right? But if you travel to the US a lot, this may be something that is of interest to you. So the next slide, please. Okay, so 2023 was a really good year. 2022 was a really terrible year. But when you put those 2 years together, it's flat. Okay, so as great as things were towards the end of last year, as ugly as things might have felt in 2022, you're basically break even over that period. So for anyone who says, 2023 was crazy, it was a mania, I couldn't believe how much stock markets went up, they're bound to crash, I would say, well, just add another 12 months to that, and you'll see that you haven't made any money. Okay, so it might have felt like an extreme, but that's because 2022 was also an extreme in many ways. Like interest rates in 2022, you saw Canadian bonds, okay? Canadian investment grade bonds went down by 12% in 2022, which was, if not the worst year in the history of Canadian investment grade bonds, it was one of. Okay, so what we saw last year was basically a snapback after a really terrible year. The chart on the far side, it looks like an office tower or something, but basically what we're doing there is we're plotting the calendar year returns for the S&P 500, which is the large US stock exchange or index, for every year, and it sort of breaks it down into total return for that calendar year. And what you'll see is over the last 150 years, 60% of the calendar year returns are between -20 and 10%. Okay, -20 and +10%, I should say. So that would be, these three high bars. That's 60% of all of the returns over the last 150 years. So if I were to say to you that the return for the market over the next 12 months will be between -20 and 10%, all I'm doing is playing the odds, right? So I'm not going to tell you, I don't know where it's going to go, but I think that's generally a safe assumption. If you look at the returns either on the extreme low end or the extreme high end, on the extreme low end, what you're going to find are like the 1930s, the Great Depression, okay? What you're going to find is on the extreme high end would be the year after the extreme low end. So what that demonstrates is usually things crash and there might be a huge spike up, but you're a math major, a mathematician, right? So think of it, if the market goes down by 50% in 1 year, what does it have to do to get to break even the next year? 100, right? So generally you're going to see these snapbacks. But market history is kind of an interesting thing. But again, generally speaking, -10, -20, 10% to +10 is sort of the range we're looking at. I think what IA Financial Group senior strategist is calling for is actually, let's go to the next slide because I think I've got some more stuff. So before I get into the prediction, and I think I demonstrated how valuable predictions are, or how valuable forecasting is, it's really not. But Rob invites me here every year anyway. But let's talk about financial conditions. So the Bloomberg Financial Conditions Index is basically a real-time measure of things like credit spreads, the price of oil, mortgage rates. It's sort of let's call it, it's sort of like the temperature gauge in your car, right? It doesn't really tell you what's going to be happening an hour or 2 hours from now, but it tells you that things right now are pretty good, at least as far as that is concerned. So this financial conditions index is kind of the same thing. So what we're seeing now is that the financial conditions index is back to where it was before interest rates started going higher. Okay, so essentially the economy's been able to swallow and digest a move from 0 to 5%. Okay, and a move from 0 to 5% faster than a move from 0 to 5% ever. Right, so the move was rapid because central banks had to battle that inflation demon. They've done it, reasonably successfully so far. So we've gotten through that, and right now, at least as far as this measure is concerned, okay, things are looking pretty good. Okay, so that's a pretty good backdrop. So next one. But what does that mean for stock markets? And where are things in terms of what's expensive, what's not expensive? Generally, when you're investing in stocks, you want to buy things that are cheap, hoping that they're going to go up. You want to get a deal, right? It's sort of like you go shopping. You want to make sure that you're out there looking for a deal, because in the stock market, if you're buying things that are very, very expensive, it doesn't necessarily have any influence over what might happen in the next year or two. But studies show that when you buy stocks when they're expensive, your longer term returns will be impacted, right? Maybe if you buy the most expensive stock market today, over the next year, there's not really a relationship there, but over 5, 10, 15, 20 years, there is a relationship. So a lot of numbers here, I know, but what we have here are a series of different stock indices, benchmarks: Canada, US, the S&P TSX is Canada, the S&P 500 is US. These are all a bunch of different valuation metrics in the green. And then on the far side, where it says median, what we've done is we've sort of added those up and compared them to where things stand vis-a-vis the last 10 years or so. So you see, for example, Canada is 28%. What that means is the Canadian stock market, based on these metrics, is in the 28th percentile in terms of valuation versus where it's been over the last decade. What that means is that if you flip 28 over, the inverse of that is 72, right? So the Canadian stock market today is cheaper than it's been 72% of the time over the last 10 years. Okay, so that's pretty good. It means it's relative to history, you're getting a good deal. Now, valuation is never in itself a catalyst or a good reason to buy. Just because it's cheap doesn't mean it can't get cheaper, or that you'll make money in the next year. But what it does mean is that over a longer period of time, your likelihood of doing okay is there. So if you're going to buy Canada right now, it doesn't mean you're going to make a fortune in the next year or two, but it does mean that over time, you're probably better positioned for success. Okay, so you compare that with the NASDAQ, which is the US technology index, essentially. You compare that with the S&P 500. Those are at 82. So 82 and 85 respectively. What that means is that they're more expensive now today than they've been, I guess, versus 85% of the other periods over the last 10 years. So they're at the other end of the spectrum. So what we're saying here is that Canada is a pretty cheap market. Now, some of that is a function of what the Canadian market consists of, right? There's a lot of financials, the banks, a lot of energy. These are things that are traditionally cheap. What do you have in the US? Well, in the US, you have the greatest technology companies, or even some of the greatest companies to ever exist. Some would suggest Apple is the greatest company in the history of the world. And it's hard to argue that, right? But certainly the biggest, most dynamic companies in technology and beyond, those are US-based companies. That's a function of just US dynamism, just the culture, regulation, so on and so forth. We don't need to get into it, but the bottom line is the composition of that market is very different, right? And those are very popular stocks, and Rob can talk to you about some of those names, whether you own them. But my point here is that the U.S., at least relative to itself, appears to be pretty expensive. You could say the same thing about the global index, things like Japan, small caps, international stocks, maybe not so expensive, but that's sort of a lay of the land in terms of what looks cheap, what doesn't look cheap. And keep in mind, these are just overall indexes of hundreds of individual stocks. What's happening on an individual stock basis is a completely different thing. So you kind of don't want to lose the forest from the trees here. Or maybe you are losing the trees from the forest if you are looking at this top-down number. But there certainly are many tremendous opportunities in all of these markets, regardless of the top-down valuation level of the overall market. Next one, please. Okay, basically this is a slide that just says bonds look pretty good right now. So we'll go to the next one. And final slide, which is sort of the house view of what portfolio positioning should look like if you're running things very tactically, if you're very active in making changes. Now, I don't endorse, and I know Robert doesn't do this when he's running your portfolios. He's not making changes every week, every quarter, buying more bonds, selling more stocks based on the whims of the market. But when you're a strategist like the individual who put this together, he's sort of paid to make those calls, okay? So what he's basically saying right now is cash is a pretty good place to be because you're getting paid a decent amount to continue to hold cash. Now, if interest rates go down 3 to 5 times as the market is projecting, I don't think we're going to let cash as much as we did, or as much as we're demonstrating here. Now, fixed income, we've got a little bit of an underweight. We don't like fixed income as much, even though I just told you we like fixed income. That's because the most risky end of the fixed income market is what's called high yield. So these are companies that are of the least creditworthiness of all companies that borrow. You might have heard the term junk bonds. Okay, so a high yield bond is a junk bond. And in junk bonds, you can make a lot of money because you can earn a very high yield. But at this point in time, we think that they're a little bit risky. Now, as it relates to stocks, I think we do like Canada a little bit more than the US at this point. I think we're looking for a return, sort of high single digits for Canada. I'm not going to say this year, I'm going to say that from this point forward because the US stock market year to date is up like 13%. Canada, something similar. So from this point on, we're expecting probably something closer to 10% for the rest of the year for Canada, from the US a little bit less. Although, you could pack up your bags and say goodnight for 2024, and you would have probably had a better return than average from the stock market, just given what we've seen in January and for the first few weeks of February. So what we're witnessing is definitely not the normal. Not the norm. It's unprecedented in many ways. I've heard some people suggest that maybe the market's peaked, suggesting today might be the peak of the market for the year. And if it is, so be it. But again, that's their guess. And frankly, your guess is as good as theirs. Because in the short term, the ability to predict the future of the markets based on any metric, short term, it's a fool's errand. It really is. But if you're looking at some of these valuation metrics, again, as I demonstrated, if you're talking 5, 10, 15 years, that's when it comes into play. And that's when really the idea of staying disciplined, listening to Rob and sticking with the plan that he and Russ would have established for you. I think when you're a financial advisor, half the time you're also amateur psychiatrist. And I'm sure you're fielding calls all the time when the market goes down aggressively, because that can be scary, right? This is your retirement portfolio. This is the portfolio maybe you're saving for your child's education or vacation, or everybody's got different goals or different dreams and that sort of thing. And the value of a financial advisor in many ways is just keeping you on that track, right? And I think there have been numerous studies, annual studies demonstrating that the value of an advisor can be measured in percentage points, and it usually is between 2 and 3% a year. Okay, so that adds up over time, and that's really by just doing little things like staying in the market. Or bottom of COVID, March 17th, Rob, I want to sell. This is crazy. Rob saying, you know what, let's just sit tight. We'll make this work. You've got 5-10 years before you actually need that money. And guess what? He would have been proven right because the market got back to where it was by like September, which is crazy. Let's go to the next slide if there is one. Okay, so I'm happy to field any questions. Robert, if you have any questions for me, happy to field those too, but hopefully that was done in adequate time.
I think I'll go first. That's okay.
Yeah.
First of all, it's fine not to be political here, which is good.
Mm.
Okay. But tomorrow on the chairlift,
Mm.
ask some questions. I have a question, and we hear a lot about it. So I don't know if you're watching BNN, you certainly hear lots about it. But what about commercial real estate? So I'll ask you, Toronto, certainly San Fran, some of the North America. Any comments on commercial real estate?
Yeah, commercial real estate is in big trouble. Lenders to commercial real estate, developers or landlords, it's a challenging space. I think it's obvious why. Our company, IA Financial Group, our policy, and we have a lot of real estate, right? Downtown Toronto, Montreal, Quebec City. Our policy is work from anywhere. And when people are given an option to work from anywhere, guess where they work from? They work from their home office. Okay, so what we're doing, we have an office on at 522 University Avenue. It's a 13-story office building that we occupied most of. We've sold that building. It's going away. It's being redeveloped. So there's a massive dislocation in the office market. It's slow moving. I think some of these office buildings will be repurposed as residential. That's a tricky thing to do because an office building is not designed like a residential condo. So there's all sorts of logistical challenges. The stocks of real estate property owners, real office REITs, as we know, real estate investment trusts, they've been absolutely demolished. And a lot of those banks that were big lenders to these entities, they're in trouble. So this is a story that is still playing out. There are other areas of real estate like industrial or multifamily that are doing just great. You talk just going off on a tangent here. You talk about the amount of immigration in Canada combined with how expensive housing is. The rental market is going to remain robust. Like people need a place to live, and even though the prices of rents have gone up like this, well, good luck making a down payment on a home in Toronto if you don't already own a home, or you don't have parents who are willing to give you one, or here, or Vancouver, like any small town. I know you're from Kingston. I'm sure the prices in Kingston are just crazy too. So. It's I think it's isolated to office, and I think that's for reasons that are primarily related to the shift that has come as a result of COVID.
That's an excellent segue into the first home savings account. Again, podcasts, send it to your nieces, nephews, grandkids that are not in the housing market. It is a great account to just set it aside and say, at least I'm doing something to build towards. And just a quick story on that. Like I have a few clients, children of clients that are now clients, that one's a server and she put $8,000 into her first time savings account. She doesn't really need the tax deduction, but she set that aside and that's her goal. She's doing something to move forward on the huge task to buy a house in this country. Questions?
I appreciated the discussion on causality about the situation in Canada. I just wanted to come back to the point about international students. I too read Global Mail, and I know it's a particular issue in Ontario under Death Court, like a really, really big one. But to me, the situation with international students is part of a much larger picture, whereby my best understanding is that the provinces receive federal transfer payments for education from the feds, right? But those payments are shrinking and shrinking. Does that correspond with your?
This is far from my area of expertise.
Okay,
But continue. Okay.
I think part of what's going on in Canada is demographics. We also have a very aging population, right? And our healthcare system is in great So, as I understand it, healthcare is taking a big chunk of the money and our aging population. So I think, just again, from my perspective, I would have liked to see, I don't want international students to be blamed for what's going on.
Well,
I think there may be a piece, but
I'm simply stating that when you have economic Canadian GDP is a number of X. When you divide that by a number Y, you get a ratio. When that bottom number, the denominator, is bigger and the top number is not getting bigger, then your ratio is smaller. So that's all I'm demonstrating with that. Again, I'm not.
So yeah, that's just one stat that people like to look at is GDP per capita. So we compare
Right.
that to the US, which is really not fair because you have Apple, which I believe is one of the best companies we've ever seen, in San Francisco. San Francisco? No, yeah, San Francisco. And then you have Amazon beside them, and like it's tough, but they're 320
Yeah, I think
million people.
So putting the students aside, and again, I'm not making a political statement about that. But what about housing, right? So we talk about housing, and you hear politicians like to talk about things that touch a nerve, right? So you talk about housing, and we need more housing. There's not enough development, and we need to get into areas where there's not development. We could ramp up the amount of housing built by a factor of 5. And given the amount of immigration that's coming into the country, you would not meet that demand. Okay, immigration is good, right? Like look at China. China and Japan they're net exporters of people, right? They produce their own people and they export people. They don't take in new people. I don't know if you've ever been to Japan, but it looks very different than downtown Toronto. I mean, everybody's Japanese is what my point is. So when that happens, when you're not taking in new people, you're going to experience what China's experiencing. Their population is going to get cut in half by 2080 or the year 2100, and that's not conducive to strong economic growth. That's a problem. That's a major problem. So you do need immigration, but then the question of housing. Everybody, you're not Canadian if you don't like to talk about the weather and housing, right?
and health.
And health, right? And the other interesting thing to note is just the amount of government debt that we have in the books in both Canada and the US. Now, the expectation, given the current escalation of US debt with the current interest rate level, is that the US federal budget annually, 100% of that will go to pay off the debt by 2060 or thereabouts. Meaning there's nothing left for defense. There's nothing left for other government services, handouts, so on and so forth. So that's a major problem, right? So what that means is that the debt will just continue to feed on itself until at some point someone will say, you know what, I no longer trust the credit of the U.S. government. So these are long-term, not even that long-term anymore, but these are secular problems. These are major challenges because it's difficult to take away the punch bowl, right? Once you give a population a certain benefit, they're going to come to expect it. So, in Canada, good luck pulling some of these things away. It's political suicide, right? So I don't know how someone's going to stick their neck out and expect to remain in office if that is their strategy. Although I don't know if any of you are following what's happening in Argentina. There you have, Argentina has been rife with problems for decades. But you have now the president of Argentina is an economist by training, who's libertarian in terms of his political leanings, and he's basically slashed economic spending, and he said, I'm going to set this country right, this country straight. We'll see if it works. And, whether we get somebody like that in Canada or the US to make those tough decisions will remain to be seen. But the bottom line is the math is the math. Okay, at some point, you're going to run out of money for everything else if you're spending it all on servicing your debt.
Give it to positive Pete here. So the U.S. big problem is that they don't have a GST. So lots of people talk about, if you just did a 2% GST there, it might enter a rate to debt, might help. There's no other continent you'd rather be in than North America, in my opinion, for a lot of reasons, which you said about China. declining population. They do not have a female workforce that we have. North America, the innovation technology is going to help us. It already does. There's problems with technology, but the net is a huge benefit. And certainly healthcare, what we've seen. And I can remember being at a conference in California in 2015, and Google was there, and they were talking about Google Health then. Like, they will be able to text your doctor that they should look at your heart and, get you in, and boom, boom, boom. And so, yeah, innovation is huge. It's a double-edged sword, certainly with IA, with artificial intelligence as well. Yeah, so any more questions? Any questions for Bill?
Yeah,
Paul.
I was going to ask Bill, how healthy is it?
Come on up, Bill.
How healthy is it to have more than, say, 11 TikTok videos in your
Okay.
feed?
Something for the chairlift tomorrow.
Actually, I do have a question for James. First time, long time listener, first time caller.
Oh, appreciate it.
So I didn't see in your charts anywhere there where you're predicting how far the Leafs are going to go in the playoffs this year. My friend really wanted to know.
In Toronto, we'll be looking for tickets in June.
I'm pretty sure if you check the sports books, they'd be
13-1.
okay. This is I'm actually not a Leafs fan.
16-1.
This
Yes,
is-
and the Canucks, absolutely.
Well, if you're a contrarian, then you're going to believe that the Leafs are going to win it this year. But good luck to them.
The good thing is there's 3 or 4 Canadian teams ahead of them. Or 3.
So we got the sports out of the way. I guess I covered everything else, and if not, that's what this man is for.
Mark?
Yeah, where, I'm not going to hold you to it, of course, James, but you said a couple of cuts perhaps for interest rates, so where would you see the interest like down, but
Thank you, Mark, for the question.
quarter-point cuts or?
So the U.S. policy rate is 5.5%. Canada, it's 5. So most of you, if you have a variable rate mortgage, it's tied to the prime rate, which is the bank's sort of preferred rate, and that's usually a little bit above the Bank of Canada rate. But I think it's, the market is looking for 3 to 5, probably starting with the first cut of, and what we're going to see is 25 basis points at a time, so 0.25% at a time. If we see cuts of a number more than that, things are going wrong. Okay. If you don't see a cut, then something is going wrong. So what we see in terms of the market and market reaction, everything is a function of expectations, right? Everybody's expecting this to happen. So to your question directly, 3 to 5, is it 3? Is it 5? I don't know. If it's less than that, then something's gone different from the expectation. If it's more than that, then things have gotten seriously worse economically. So you probably want 3 to 5.
Bill, you want to come up here? Bill, what would you say to a guy that's just newly retired, moved to the valley, had a greenhouse delivered to them? He's busier today than when he was my boss a few years ago. Mark Neal just moved to the valley last May. I've only seen him maybe once or twice. Can't ski with us tomorrow because he's off in Tofino, but yeah, so he'll be at your seminar. He might even be on the panel because he retired very poorly. Not financially. Any other questions for Mark or James?
I have a sort of a question or a comment. What would you think of the comment that we don't really have an affordability and housing crisis in Canada? We have a location crisis in Canada. Apartments for rent in Saskatoon, $1,000 a month for a 2 or 3 bedroom. Same thing in Vancouver, $3,500. Working from home, same job.
Mm-hmm.
In other words, we've concentrated around big cities and single homes in Vancouver. No big city in the world has single home in Vancouver. Some in Toronto. Is that a thought process, or is that just whimsical?
No, I think location certainly matters. There's no question about that. However, I think during COVID, we saw a phenomenon. So I'll just speak from an Eastern perspective, an Eastern Canadian perspective. COVID happens, people who are living in Toronto, otherwise commuting into Toronto, are saying, oh, I can move to London, which is a 2-hour commute. Or I can move to Niagara-on-the-Lake, which is a 2-hour commute. Or I can move to Kingston, 2-hour commute. These are people who sold their homes to move. And if you talk to the locals, and I'm originally from Windsor, Ontario, which is about a 4-hour drive from Toronto. The property market there was always probably comparable to Saskatoon. Under the radar, arguably not the most desirable place. You have a steady stream of people making a good working class wage, but not a bunch of people. I mean, it's not a professional industry place. But because of people coming from Toronto, I heard of properties in Windsor, 21 offers, 21 from people in Toronto. And what does that do for the property market? It does that. So Saskatoon, I don't know if a phenomenon similar to that occurred, but I was reading something about Calgary.
It was only a Prairie's example.
Yeah.
Because it's littered with them from
Yeah.
Weyburn, Saskatchewan to Boise.
Yeah, so I think it's entirely based on location. If you're how far away from your job is your employer going to permit you to be? Well, if you're required to come in 3 days a week, do you want to be living 4 hours away? Well, that will require you to either commute 8 hours each day or stay over. So eventually you're going to see sort of a retrenchment probably of people who thought, I'm going to move to, my cottage and I'm going to work from there. Oh, my boss wants me back in the office. That's going to require some sort of retrenchment. So longer term, I don't know the Saskatoon or Saskatchewan market all that well, but yeah, like anything in the real estate world, it's location.
Yes, go ahead, Steve.
Still on the housing thing, supply and demand. So when demand outstrips supply, then prices go up. So
Yes.
basic principle. I read that 25% of all homes bought in Canada are bought by investors rather than people who are going to live there. And so, just curious whether that participation by investors in the housing market is having much.
The answer is yes, absolutely. However, if you're an investor in the housing market today, you're looking for an opportunity, your cash flow is negative. So, and it would have been negative probably for many years prior to that. People were getting a negative cash flow situation, but the price of the home was appreciated. And in a zero rate environment, that's okay. You can afford to do that. But when rates go from, when you get a mortgage at 1.5%, that's very different when the mortgage rate is 6.5%. So at 6.5% negative cash flow, the price of your house is going down. It's slow moving, but that's going to push out a lot of people who otherwise would have been looking for an investment property. And it probably will break the back of some of those who went out and bought something on a speculative basis. And they're saying, I don't know what I got myself into. I got to sell this thing. So it'll naturally correct itself, at least as far as that's concerned. How much of that is driving the overall picture versus the immigration thing versus just general market demand? It's tough to say. These are all contributing factors to it, but I think you hit the nail on the head. It's a supply and demand issue, and there's more demand than there's supply.
Now, supply is coming on. I'm not sure if you in Ontario have this, but the NDP has put in vacancy tax. So I had a friend visiting here from the interior, and he could not believe that the NDP he finally got enough money to save for a semi-vacation rental place, and he's getting smoked on taxes. So and Toronto, you guys know something about that, the 10% increase in property tax. So it just happens. Like they say that in capital markets, the cure for high prices is high prices. Because if it doesn't cash flow, the investors are gone. And then you've seen some work with money laundering in British Columbia. If you want to read more about that, check out Sam Cooper. He's been the one that's been doing a lot of the foreign interference stuff. Very good writer. And the other thing I'd say is there's a company called Zillow. I don't know if you've heard of it. 20 million views a month on this. So if you want to know what the property value of their house is, Zillow, they got into the property market, I think it was in 21, they started buying houses. Well, they got out of it right away. They said, done, 10 months, that was a bad idea, sold it all. And they were buying houses like weekly. And they just go and they give you one offer. This is your, what do they call it, Zillow estimate, we'll buy your house. And I think they dumped the vast majority of what they own. I think we'll wrap it up if there's no more questions. It's a phenomenal business that we're in, the wealth management business. I have the pleasure of seeing speakers like James and the people that James bring in. It's a real honor to have you here, and I know whenever I call you, yep, I can make it, and it'd be great to ski with you tomorrow. So I want to thank you. You flew in today?
Last night.
Last night, you've been in meetings all day today, traveling up the island, so much appreciated. The one thing I'd say about 2024, we talked about it, the election year. I think there's 40 or 60 different countries having an election this year. I think Singapore just
50% of the world.
50% of the world. So it's a phenomenal business we're in. You got to pay attention, but we're living history when that kind of stuff happens. I mean, look at who the candidates are in the U.S. I mean, holy cow, hair back, way we go, right? So, nothing against Joe Biden, but yeah. So thank you very much. It's going to be interesting. It's nice to have yourself and the team at IA in our corner. And thank you. These are chocolates. You can bring them tomorrow.
Thank you.
Right. And, Bill, thank you so much. I'm so looking forward to May 9th. Much appreciated.
Thank you
That's
very
it.
much. Yeah.
And thank you all for coming.